All right, welcome to another episode of Leaders in Lending. This episode, I'm joined by Armen Meyer. Armen, welcome to the show.
Thank you for having me.
It's great to see you again and chat live. I know we've had a little bit of time getting on each other's calendars. We've been chatting a little bit about the recent CFPB ruling and the Supreme Court's take on its funding and legality of that. So I'm interested to hear your perspective on that, even a few weeks after that, if anything's changed, or maybe we should start by just going into the case a little bit and who brought the suit, why did they have reason to bring it, what happened?
Well, sure. The good news on this topic is no matter when we discuss it, it's a gift that keeps giving. There will always be challenges to CFPB. Since we last spoke, two new arguments against the CFPB have arisen in public forums. We'll probably see them make their way into litigation. So just because we're talking about something that was ruled on a couple weeks ago doesn't mean it's not going to be relevant for, in my view, unfortunately, many more years. But this particular case was an extension of other efforts to kind of, I'm going to say, almost blow up the CFPB. This was the latest version came from a trade association of higher price, shorter term lenders who did not like a particular rule which affects payday lenders, defined as those who make loans with a duration that's a full repayment under 45 days, and higher price long-term lenders, those whose loans extend over 45 days, but their rate exceeds 36%. You can imagine why some in industry would be okay with this. You can also imagine why some in some sets of industry would hate this. So that was the origin, was taking on this rule and making one of many claims. The typical claims you make in these cases are you exceeded your statutory authority. You didn't follow the Administrative Procedures Act. You were arbitrary in the rulemaking. But this one, in past, we've seen, and your structure is horrible because you should be a board and not an individual leader. We've seen those in the past, and that's been decided. We'll get back to that later, perhaps. But in this case, the argument was, and the CFPB shouldn't be getting money anyway because it's unconstitutionally funded, despite the fact that Congress laid out the law for how it should get funded. The idea is that that's unconstitutional because it violates the appropriations clause of the Constitution. And I'll spare getting into the legalities of that. But that was the thrust of it. And what we saw, of course, was the Supreme Court reject that argument pretty heavily. I think Clarence Thomas wrote the opinion. And I think a reason it was rejected, and I think it's good it was rejected, but a reason it was rejected is because the implications of such a finding that Congress is not going to interpret its own appropriations clause, and we're going to decide that the structure of the CFPB, where it's funded through the Federal Reserve rather than directly from Treasury, therefore makes the whole thing not constitutional and essentially gone. And we can go into more details on what that means. It's a pretty uncomfortable position to be in because it's not even a slippery slope. Just right adjacent to that, it's almost hard to distinguish, is blowing up many, many other agencies who are funded not through appropriations. There's this thing called the Federal Reserve. A lot of people hate it, but a lot of people recognize, wow, COVID could have been a lot worse. And we got out of a potential serious depression because of facilities the Fed created. Or, wow, that thing called the financial crisis could have been a lot worse. We thought it was potentially end of financial capitalism if you talk to bankers back in 2009 and how bad that was. But the Federal Reserve was a huge part of getting us out of it. So you can see why a court might be uncomfortable ruling in favor of the plaintiffs here against CFPB. The slippery slope is not very slippery, nor much of a slope. It's right there to other agencies, and I could list many more. I don't want to bore your audience.
Yeah, well, you're right. There are lots of rabbit holes we could go down. And I started, in preparation for our conversation, doing a little research. And like you said, on the appropriations clause, it's interesting how some of these suits can, you're trying to find like any foothold. Maybe it's tangential to your real beef with someone in a case that you find any reason to try to bring a suit to bring them down. But it was, I think, ruled 7-2. So pretty unanimous almost, considering the court's makeup. I think you're right. Most people found reason for affirming the CFPB's funding in this case, which is good. And I think it is important, I think, to maybe hit on a little bit on the appropriations clause, because the Fed does have oversight. They are, I think maybe some of the argument was about the independence of the CFPB, or could they just run wild? But it seemed that it fit within the appropriations clause, that there was clear delineation around, how they could use their funds or how they could operate.
Yeah, I think it's also important though to be pragmatic here as well. Besides the legal arguments, I think those of us who like have businesses to run and have to do things and serve customers and make big decisions and invest in very big decisions what our product will look like. If we list, I mean, just like taking like now 3 steps back, like, do we really want to be in a world? And frankly, we're entering this world, and it's a scary place to be. Do we really want to be in a world where we're constantly taking institutions on and blowing them up? Where, I mean, if you believe that you need government for capitalism to work, because we've seen a world where there's unregulated capitalism before there was regulation. We saw what that did to people. But if you go to the other extreme, we've also seen command economies say, we don't trust you capitalists, so we're going to do it ourselves. It's super boring, but like, let's be a little moderate. I mean, I know it's not cool. I know my position is not cool here, but the idea that we're going to keep trying to blow up agencies, or we're gonna look for the next election to get our way, leads to an unlasting peace where we can win victories today as an industry, but they're going to be losses tomorrow. And there are plenty of examples of winning a rule and then seeing it get repealed. On both sides. If we could work a little more together and focus less on blowing up the agency and focus more on what's the rule of the road that protects consumers and allows growth and creates continuity and allows us to invest, we'd be in a lot better place. And there's a lot of brain damage, if you ask me, on how the CFPB is ruining our lives, when in fact, there are ways in which it has been aggressive, and we should talk about that. But there are ways in which it's been quite moderate. And it's been helpful to the market and to consumers. We can talk about those too. Not all regulation is bad, and we kind of should get out of our corners. And the CFPB becomes like the lightning rod of this macro argument about regulation. And we should stop post-China CFPB, and we should kind of be a little more adult, I think, about regulation and what it can do for our businesses to grow, and not just how it's a source of imposition.
Yeah, that's a great point. And I think sometimes regulation is viewed maybe in this adversarial lens, but I think you bring up great points around, balance or stability. And let's find the middle ground here, because I think in any system, there's going to be bad actors and people trying to exploit, weaknesses or for their own gain or take advantage of consumers. But I think there are also groups out there trying to lay that common groundwork or find fair rules for everyone to play by. And there's still spots for innovation within that if everyone agrees to what's best.
One example, if I could, I mean, I was chief of staff of New York's bank regulator. And during that time, we were diagnosing the financial crisis. I went over there during the crisis to see if I could be of some help. And that was kind of my entry point from broad economic policy with some financial services into full-blown financial service policy about 15 years ago. And a thing that came out of Dodd-Frank that we could all agree to was regulation that was not just good for the consumer, but was good for the economy and good for the banks and good for the lenders. So the one example I'll make of this, which I think is probably best for a lending audience, which I believe is our audience, and there are many, is of course the qualified mortgage rule, which basically says we need regulation that ends this idea of opacity and non-transparency to consumers, because it's not just bad for the consumer. We end up having to have a race to the bottom. We have to compete on grounds we in industry don't want to compete on because someone else is going to obfuscate or mislead. So let's just create a mortgage product that is qualified to get out of this liar loan scenario and other scenarios that ended up being a race to the bottom, increased sales, but it was all short term. And it's one of many reasons, but it is an important reason why the financial crisis happened, that we were selling loans to people that they couldn't afford. Industry was doing that. And it didn't have to be. And I think that what came out of the crisis was, wow, we do need rules that stop these races to the bottom and that then allow investment in a more firm landscape so that you don't have to change your investment over time because others are cutting corners. You can actually stick to that good product, and then products actually get better. So those are two reasons, if you ask me, why we want regulation, and why, if the CFPB was, if this rule went down under this theory, in this case with the payday lending rule, you would have seen all sorts of other rules go down. And I can make the same argument for why the payday lending rule itself is a good thing. But the mortgage one, I think, is a bigger one that really I saw firsthand when I was at the New York Banking Department, now called Department of Financial Services.
Yeah, great. And you read my mind, kind of tying the connection to maybe some of your other earlier experience in your career. What about as a co-founder of the American Fintech Council? Upstart's a member of that as well. Like, what was some of the need you saw that arose to bring that to life?
Thanks for raising that. And Upstart is a member and an important member. It's a similar theme in many respects. I think the American Fintech Council, when a few of us got together and created it, we were thinking about how you can exploit regulatory gaps, which we've seen some businesses do, or you can fill them yourself with higher standards than what currently exists, so that you're paving the regulatory road for the regulators, for the enforcement agencies. And that's a good thing to do as you grow up as an industry, because if you don't, and you don't paint it for them, it will get painted for you one way or another. And if it's not the CFPB, because it magically blows up because of litigation, it's going to be an attorney general, it's going to be the FTC. So there's no avoiding it. You are much better off figuring out for yourself what's good for consumers and good for your business to lay that foundation for your investment to prevent those races to the bottom than you are leaving it up to an agency that is now reacting to customer harm. So we wanted to get on our front foot, and that was a major reason to start the American Fintech Council. It was also a great way of bringing companies together who really believed in doing good for customers, not just through rhetoric, but through actions and data. And I think actions and data is the way you distinguish yourselves from those who just say things. And I think the American Fintech Council members, including the board members like Upstart, have done a great job walking the walk on some issues. I'm sure the regulators would disagree with AFC on several things, but they certainly have to concede that we've walked the walk on several issues and have pushed regulatory landscape forward, and have ourselves obviated some risks of bad rulemaking because we got on our front foot with some good rulemaking.
Yeah, that's great. Did you find it was easier bringing a disparate group of companies together under an umbrella, or getting regulators' attention, or did you find, maybe describe some of the challenges or opportunities in that experience?
No, sure. I think at first, when you tell people what you're trying to do, they think you're crazy, to be honest. Why are you going to raise standards? Are you nuts? And then what I found was maybe we didn't get everyone we wanted in the beginning, back in early 2021. But as the Biden administration came in and they started creating the standards by enforcement actions that weren't always visible, or by behind the scenes supervision, I always said, if we build the umbrella of people who are pushing the envelope and creating standards together, others will join us as opposed to be repulsed by us, because they're going to see the value of being in a group that is forward thinking, and they're going to be a part of us. So as 2021 went on, we did find our membership increase by folks who were feeling the impact of the new administration and needed help getting on their front foot and telling their product story, because it's too easy without some help to leave value on the table in terms of the good you're doing and to just allow the regulators to see the bad. So I think we were able to bring folks in. And then we also wanted, Lending Club, where I was at the time, we didn't want to just create an umbrella of actors who wanted to push the envelope. We wanted to create an ecosystem. We started very, very early on in the legacy organization, one of the legacy groups of the AFC, as just lenders, non-bank lenders. But as fintech evolved and fintech started doing more and more different things, Lending Club, for instance, bought a bank. We saw, and banks were now partnering with fintech in a lot of new ways that weren't just focused on lending. So this whole vast banking thing that, unfortunately, there's been some negative headlines, but some not awesome conduct, which is now staining those that are actually doing great for consumers and doing great partnerships. But anyway, we wanted to bring some of those folks together because the ecosystem was evolving, and we wanted to create the synergies between folks to work together to advance better policy and work with partners who are more responsible and to kind of help create that ecosystem. And I think we succeeded there. And I want to really commend our management, our current management, for what they're doing.
Yeah, absolutely. Definitely important work. And so you mentioned Lending Club. Yeah, a lot has changed since the great financial crisis, the CFPB that we've talked about, American Fintech Council, the introduction to more fintechs and partnerships, or fintechs becoming banks. Any other like major trends that you've noticed in that
I
time?
mean, to me, what's so exciting is the regulatory technology trend hastened by generative AI. And I know, AI is a very big word, and just like fintech, everyone wanted to be a fintech 7, 8 years ago. When fintech started, suddenly everyone was a fintech, right? Now we're seeing everyone wants to be AI. But regardless, I don't mean to jump into hype. Generative AI, creating content or analyzing unstructured data and structuring it in ways that humans have not really been good at and in ways that machines have been horrible at. This new technology is the basis of a huge regulatory technology and supervisory technology framework, if you ask me. And we're going to see really interesting companies emerge more and more that are going to figure out how to meet regulatory standards. And I know it's scary. It sounds scary in the beginning, but think of AI as your junior compliance officer to take that first cut. It has to all be supervised, but we're really going to be able to automate and improve and a lot of compliance hurdles, which are going to be better for consumers who are going to do it better. And it's going to be better for smaller entities who can now compete more and create a more competitive market because they're not throwing so much at compliance costs. So I'm super excited by regulatory technology and the use of generative AI. And I hope we don't ruin it by having folks be a little cavalier and use generative AI a little avant-garde without the proper controls in place. It is on us in industry often to see the value of our work by being incremental and by communicating with regulators what we're doing and not starting with the most risky area. So I hope we're not going to take our Gen AI and start underwriting. I don't think people will do that, or start engaging with customers directly and leading to bad outcomes. This is risky stuff that people are too smart to do. And I think we need to educate regulators and policymakers on the great use case of Gen AI, which are not going to be customer facing, which can be heavily supervised, which we have great model risk management over, which are actually going to make the economy a lot better and empower small banks and small entities to grow.
Yeah, totally agree. And I think again, like the themes around transparency or explainability and using these, keeping the human in the loop, so to speak, I think are really important in these early days. Super exciting times and lots of use cases and technology and companies coming up right now. But I think you're right. I think it could be used a lot proactively, doing research, or the way it's enriched and helped search. Anytime there's a huge body of work you're trying to sort through, it can accelerate the degree of which we can comprehend or just get a handle on something as complex as regulation. So definitely excited to see what comes out of that.
A lot of work to do, but a lot of opportunity. And I'm normally one of these people who is skeptical on these things. And I think you're putting your head in your sand if you're overly skeptical on the potential here, but you're putting your head in the sand if you're not looking at the risks that you just laid out that we have to get a grasp of.
So I guess we've talked about this a little bit, but would you say the CFPB has been successful in the decade and a half since it's been around? Like overall, all things considered, I was reading some stats. It looks like they've taken in maybe 4 million complaints. The last figure I saw is of end of last year. Billions of dollars in funds back to consumers. Like, how would you judge its success?
Yeah, I mean, I think those are important metrics. They're not the ones that I would focus on first. I guess I like to look at how has the CFPB made the market more stable and improved almost the thing you can't see. Have we seen companies emerge and grow up because of a more stable environment that protected consumers, that these companies weren't AG'd out of existence or forced out of existence, but there were rules of the road that allowed them to thrive, that were reasonable enough and protected consumers so that the product was long lasting. And I think under that metric, boy, hasn't a lot of great stuff happened in the last 15 years? I mean, I take issue with something the CFP has done. And I think anyone that like loves the CFPB, every action is going to, um, I think it's hard to pick any agency, including the CFPB, and love everything they've done. But, and actually, let's lament on two things I think are not the greatest and that we should ask for more from the CFPB and from government on. One is going back to the seesaw. Um, I like the initial 5-year structure where there was independence to the CFPB, where the director was in for 5 years. Unfortunately, some in industry, in an effort to blow up the CFPB, similar to this case we started off talking about with the payday lending rule, went at the CFPB hoping to blow it up. And what they got was the end of the 5-year structure and instead serve at the pleasure of the president. Why is this bad? Because we've just reinforced the idea of short-termism and partisanship in regulatory bodies. And that's bad because now we are seeing people who just want to survive to the next election in terms of a certain regulatory regime and not actually pushing for a long-lasting regulation. And I think we're going to see more and more partisanship in our regulators, and we are seeing it. And the CFPB has unfortunately been that lightning rod. So I really do lament that we have lost that 5-year structure. I think it creates more partisanship than necessary and is a rotten apple on all of our regulators. The other thing I lament is I thought what the CFPB did under Cordry to allow companies not to get out of regulation, which is how some critics who I disagree with would call it, these no action letters or these sandboxes. But let's be honest, regulation can be vague. And sometimes that clarity is needed to invest and grow and serve customers. And I don't think ending a program that created clarity to allow companies to grow was the best idea. But then replacing it, saying, frankly, rhetoric, we don't pick winners and losers, so we're not going to do that. What was some of the rhetoric out of CFB at that time, ending its no action letter programs, ending its sandbox programs. I think then to replace that with, but we're going to pick winners and losers for risk-based supervision, that's a little alarming. And I wish the CFPB would rethink those approaches, because you can't say you're not picking winners and losers, but then pick winners and losers. And I think it's important to focus on how the economy can grow and regulation of that nature, rather than just saying, oh, we want to learn more about this company or this industry, so we're going to pick you for supervision. That's a little scary to me. And we've seen that movie with the Financial Stability Oversight Council when Dodd-Frank created a body to do just that. And I think there was a lot more reason to do it then, because we were talking about very, very large organizations that could bring the whole system down. And there were many, many votes involved, not just one agency. I'm a little uncomfortable with the current regime on that. But other than some of those examples where I do think the CFP is overreached, overall, I would say it's been quite successful. We haven't seen anything like a crisis. We've seen the alignment of consumer protection and safety and soundness. We prevented some of those races to the bottom that I was talking about. But yeah, we have an overreach issue, and that's just life, right? We need to push back on the CFP relentlessly when we think they're overreaching, but we also need to not be potshotters on the sidelines criticizing everything.
Absolutely. Yeah. I think fair to criticize, but also important to be a part of the solution as well. So again, it comes back to the balance. And I like how you said, painting the picture before someone else paints it for you. So important to be a part of that. Any other trends you're seeing? I think one of the things I'm anxious about lately is kind of the regional banks and how they're faring through some of the collapses recently, capital requirements, and how they maintain competitiveness in their space.
Yeah. Well, two thoughts there. One is, it's such a tragedy that Silicon Valley Bank went down. Yes, we can say they were poorly risk managed, and we wouldn't be wrong. What's interesting about Silicon Valley Bank, though, is what brought them down wasn't the thing you would have thought would have brought them down, and banks similar to it. In other words, you're making loans to risky businesses, but the underwriting worked out. It wasn't that the loans failed to the startup culture in San Francisco. Who failed was the connectivity of the deposits to venture capitalists. That's what failed. Some people will want to blame the risk management, but if any of us had a bunch of depositors connected to a dozen or a few dozen people who could get on the phone and talk and decide to pull their money, any bank would be in a lot of trouble. You don't need these arguments of, oh, it's because of the internet. Oh, it's because of able to pull your money quickly. This was unfortunately a shot in the foot of the venture capital industry to the venture capital industry. And that then exposed, of course, the decline in these bond prices. And so now we have banks that are working their way out of the decline in bond prices because of rising interest rates, but they're different from Silicon Valley Bank because of the deposit base. And that is, I think, one of the major distinguishing features that we don't focus on enough. So the crisis is somewhat contained, but there is trouble. But I'll go back to where we started. I think that the mark of success for regulators and the CFPB and us as an industry will be, can smaller entities thrive, or do we keep having to consolidate? To your point on regional banks, we want these smaller banks to be able to invest in technology, whether it's the reg tech conversation we already had or an ability to reach consumers, partnering with an upstart, partnering with other providers. Because if they can't, then they got to buy the tech or build it in-house themselves, these smaller regional players. And it's just not realistic in this world. The big banks have gotten so big. They have an infinite tech budget compared to, I don't know, the bottom 1,000, 2,000 banks, 1 versus 2,000. Of course, they're going to need to outsource some tech, because if they don't, they're going to lose and keep losing the big banks. So we can't on one hand say we got to preserve the small banks and the regional banks, and we don't want to see consolidation on regionals, but then say, but if you partner, we're going to look really disfavorably on that with technology companies, but then let the big tech companies go ahead and invest all they want in technology. It's an obvious cycle. And I want the big tech companies to invest, but I want the smaller companies, the big banks to be able to invest in tech. But I want the smaller banks and the regional banks to be able to invest as well. And you can't, all investment isn't equal in a world where one has a ton of money and one doesn't after years and years and years of consolidation. So that's kind of my worry for the regional banks in the more medium long term, but we do have to get through the present situation. If I add one more thought, this brings us kind of the open banking rule, which is the same idea. And it's another source where I hope the CFPB gets it right. And I'm glad they finally issued it. And basically what it does is, if the economy has highways that allow infrastructure that allows companies to grow, one of those, of course, a financial system and money and finance. And there are others, and the other is data. And what the CFPB is doing with its open banking rule, which is pending right now, hopefully, is allowing data to flow more. How does this relate to the conversation on big banks and medium-sized banks? Because again, we've allowed big banks to get so big that they have a monopoly on this data. So either we use regulation. This is another example of good regulation. I mentioned 2 earlier, ability to invest and not have a race to the bottom. A third one, which I'm glad the CFPB is doing, is creating an infrastructure that allows competition. And in this case, the infrastructure is not payment rails, but is data rails and free flow of data. Because if we don't have this free flow of data and the customer can't own its own data, then all we're doing is reinforcing what's the trend for decades, which is big banks using their power, in this case, data power, not market power, to grow faster and hoard and put others at a disadvantage. So we need the open data banking rule to allow other entities access that data to underwrite better, to provide better products, to transfer accounts from customer to customer more easily. And that's going to really open up competition. So going back to where we started on success of CFPB, if this rule comes out the way it should, I would give the CFPB huge credit for doing what a regulator should do, which is create a foundation for great economic prosperity while protecting customers. And I really hope they get the balance right here as they finalize this.
Yeah, great point. And maybe I'll have to put a pin in that and come back and talk after that's been settled and on a future episode and see how that's landed. I guess selfishly, one of the things I like to ask guests, especially as this continues to increase in complexity, is there a thought leader you follow, a source of information, maybe a recent book you've read or a podcast? Like, how do you stay abreast of everything going on in this space.
Well, besides Upstart's podcast, of course. If you haven't read him, I think he's really making a name for himself, and he's been really deep on a lot of the issues in ways that almost no one else is. Jason McCullough, who issues FinTech Business Weekly, it is subscription only, but he does give you tidbits to get a sense of what he covers for free. But I do recommend a subscription. I'm not like his agent or anything, but I've just been so impressed. I want to give credit where credit is due on someone who can really dig on some of the big fintech issues in a way that I haven't seen others be able to do. There's a lot of credit. Broadly, I just want to credit the reporters. I mean, we trash reporters a lot in the public media and in government, but maybe we in industry can pay some respect to the way we just so quickly learn about Rohit Chopra's latest speech or whatever from a really amazing reporter network in the business and finance space that I'm constantly impressed by. But Jason, I don't think we'll call himself a reporter. He's more of a deep diver, and I'll make those 2 points here.
Awesome. Yeah, that's new to me. So I'll have to add him to my regular reading. I think you're right. Like, it seems like journalism isn't dead in this age of social media, and everyone kind of pretends to be a journalist or can get their opinion out there. It's good that we have people still out there searching for the truth and researching it. I've been a big fan lately of the podcast Acquired, if you haven't found that one, but they take, a 3 to 4 hour deep dive into companies, foundings or acquisitions. And, I largely to subscribe to the theory that there's nothing new under the sun. So it's always good to go back and hear how companies have faced similar challenges to we're seeing today at different times or how they've gotten through.
Well, I'll check that out. Thanks. I've heard of it, and I think I might listen to it once, but I'm not connecting it. So I'm going to double check that. Thanks for mentioning Acquired.
Awesome. Well, thanks for the time, Armen. Always great to catch up, and appreciate it.
No, thank you. Great talking to you again.